Or you just do it from here?
We're all good. Good morning, everyone. My name is Justin Sears. I'm here with Sheila Stafford. We'll do intros in a second. But if you were looking for a webinar other than the shifting landscape for jobs in manufacturing and logistics, you're in the wrong webinar. If you're with us for the right reasons, let's jump in. Like I said, I'm Justin Sears. I run marketing at TeamSense, and I'm here with Sheila Stafford, who's co-founder and CEO of TeamSense.
Morning, Justin.
Morning, Sheila. We've got a really great topic to cover today. Sheila, of course, is expert in the manufacturing industry. She's been in it for a while. Myself, a little bit less so. But we're going to be talking about labor trends. Housekeeping beforehand, there's question and answer time at the end. Please send questions throughout. If Sheila or I say something that's interesting that you want to learn more about, please send a question in through our Q&A functionality in the Zoom meeting, and we'll block some time to get to it at the end. So without further ado, let's jump in. And we always like to start with customer stories. And Sheila's been on the road with some of our other leaders last week. So keeping in mind the trends in labor, did you see anything or hear anything on the road last week that's related to today's topic, Sheila?
Yeah, 100%. So last week I was in the Detroit, Michigan area. You can see as evidenced by the snow in that photo. I visited 6 customers, prospects, we'll say, of which what was really interesting was of the 6, there were actually 2 that were brand new locations. Both of those were related to electric vehicles and the production of EVs that had just kind of sprouted out new buildings, which is something that we're seeing in the trends and we'll talk about later. The other interesting thing was just the validation of some of the data that we're seeing come through. You know, employee retention still is a huge, huge topic in these areas, and just being able to kind of engage and retain the workforce as they produce the goods that they need to produce.
That is a great segue. And so for those of you that are joining, we're going to talk about trends in jobs in manufacturing and logistics. We're going to talk about a long-term view and a short-term view. So let's start with the long-term, or 12 to 36 months. Here's some of the top reasons that there are changes in manufacturing about attracting talent, retaining talent. Sheila, run us through some of these.
Yeah, so it's a really exciting time to be in manufacturing. It's really getting kind of its due focus for being the backbone of the economy. There's lots of things happening as well on the global scale. You know, we've come from a time frame of globalization where supply chains have been, you know, spread out. Then through the pandemic, where that really came back to bite us, and now into kind of what this new world is, and we'll see the impact of that again. And that's like the 12 to 36-month view. So the first and kind of biggest elephant in the room is overall global shifts in public policy and attitude towards that global trade. This is evidenced by kind of like Brexit happening in the UK and kind of the centrist attitude in the UK. We're seeing similar attitudes start to take place in Europe, and of course the mounting tensions with Russia in China. So first and foremost, overall kind of the globe is shifting from previously was like free trade all around, not exactly, but close to now people kind of being a lot more centric and a lot more thoughtful on what they produce and where their kind of GDP is going to be driven from in the future. The second is obviously tensions mounting in the US and China relations. And so many companies have supply chain ties into China. They are, you know, the low-cost provider. They've got and have done an incredible job of just building up a manufacturing base and having, you know, locations that have the sub-suppliers around them, enabling them to be very efficient, both in actual cost to produce and COGS, as well as in labor. And so as tensions mount in US and China, businesses are starting to get a little bit worried about what that means for their business and their ability to continue to produce. And that's really kind of tied to number 3 is, you know, the businesses, global businesses experienced write-downs in Russia. And so when the Russia and Ukraine conflict broke out, many businesses pulled out of Russia And then when we say write down, they just literally wrote that portion of the business off the books, including the assets. And so, I looked up some stats. There wasn't anything recent, but in June of 2022, so a while ago, given how long the conflict's been going on, that number was up to $59 billion. And so that value for businesses literally just vanishes, and kind of being burned from that before something happens between US and China. Businesses are starting to pull out of China, and do some reshoring. At the same time, going to point four is that there's bipartisan support in the US for reshoring manufacturing. And so a lot of these policies were kind of Trump era policies on bringing in reshoring manufacturing back to the US, specifically areas around clean energy, specifically areas around semiconductor manufacturing, which is then tied to national security. But as the Democrats took over from the Republicans, those same support elements have remained, and in some respects have actually doubled down. And so thinking about in the future, 2024 is a big election year, a lot of uncertainty, still expect to see that bipartisan support for reshoring manufacturing and really kind of bringing those elements back home and making sure that there's tax advantages for businesses that do that. And the last thing, which is really curious to me anyway, is the continued strength in demand for finished goods. And so we've seen kind of inflation move in the market in the US, and you would expect kind of that demand to level off or at least taper down as the Fed tries to cool the economy. And what we've seen is really curious, and that the fact that the demand has kind of remained, and in some cases have actually continued to increase. So continued strength in demand for finished goods, make sure that those factories continue to produce and have a demand for their production.
Lots of things going on, and you've talked, Sheila, about policy, politics, consumer demand, things that move relatively quickly and can go up and down. But if we think about construction, that's something that has a 2 to 6 year time horizon if you're going to put a new plant in place. And so talk to us about this graph and what it means about how quickly things can and will move in terms of the new production that's coming online.
Yeah, I mean, this goes back to that bipartisan support. Companies are feeling confident because we've seen support from both sides that regardless of what happens with the election, that those incentives will still be there in order for them to start these large construction projects. In my past life, I've been a part of evaluating sites for construction, been a part of construction sites themselves. And these tend to take 24 months if you're moving really, really fast to select the site and then kind of get up and running. And so we're just seeing the tip of this. It's pretty exciting, actually. If you look at kind of the years previous, you see 2018 to 2023, it's pretty flat. And then boom, we get that support from the government and kind of this push and enablement from companies to feel like they can take that risk. And then now we start to see those new sites come online. I think what's really interesting is if you look at the next slide, is when you pull out a bit even further and say like, okay, that's interesting from 2018. Look at this graph from 1993. Like, holy, like I swear a lot. And so I apologize if I swear on the webinar, Justin, you can edit it out later. But like, this is insane.
That's hard to do. Use short swear words so we can.
This graph is absolutely insane, and I think is really, really exciting for folks in manufacturing, right? Like, we are showing dramatic increase, and like, just look at what happened in 2023 with the CHIPS Act, and some of those incentives, and just like literally the graph is straight up vertical, and we're just getting started. We're going to see those play out over the next 12 to 24 months, even more. When digging into like, okay, like where is this manufacturing spend happening kind of from a high level? Obviously, semiconductors, what you see in the news, there's a lot of dollars that it takes to go and build a foundry. So a percentage of that is the semiconductor manufacturing leading the way. But there's also notable increases in food and beverage and chemical processing that we're seeing within that number. So really great stuff. We've got a lot of food and bev, chemical processing customers of TeamSense, and so super excited for them to see that growth. Now, one thing it does not show is also what's happening is what we're calling nearshoring and friendshoring. So nearshoring is when companies are moving out of China in particular in moving that close by, so you could expect to see some increases in notably Mexico as well as Canada. That's not accounted for here. And then friendshoring is moving out of China to another abroad friendly place. And so Vietnam is one place that's seeing a big boon from the friendshoring activity that we're seeing happening right now.
And Sheila, I was wondering about the food and bev because I think of those as perishable goods that maybe are harder to get if we're just looking at China and nearshoring. Um, is there something else going on other than replacing imports from far off in the food and bev industry? Is that some sort of organic shift, or is it mostly just shifting supply chain patterns from China to more local sources?
Yeah, I think it's a little bit of both. I mean, we continue to see, strong demand and strong focus in the food, bev, and chemical processing sector. And of course, with the global supply chain, it's well known that like when the Russia-Ukraine conflict broke out, like they were, the world's largest supplier of wheat, for example. And so the connectedness of the supply chain expands just beyond, hard goods into food and bev as well. And so there is definitely an increase from some of those changes and bringing that stuff back home.
Well, let's go to location, location, location. And what we looked at average manufacturing construction, but if you break it down by state in this case, we see a lot of variance across states. And Sheila, I know you've been involved in planning and bringing new production sites online for GM and Whirlpool. How early do these folks that are look at Texas? I mean, they're building lots of capacity. How early do they need to be thinking about filling those new production sites with trained and skilled employees? What's that thought process like?
Yeah, I mean, ensuring that you have a labor force at your new location is number one, and that was one of the things that I looked at a lot. In a particular project I have in mind when I was at Whirlpool was, one is where is their intermodal transportation, and putting the location, very close to our supply chain and making sure that we get the finished goods out. But two is there a labor force in that location that we could leverage, for the factory, or are we competing in an area that is already kind of saturated from a labor force standpoint? And so there's lots of things that go into that. And then depending on what the competition is on where the labor demand is and where the supply is, will determine how quickly you need to get up to speed. We've got a customer of TeamSense right now that has a new factory coming online in 2 years from now in Tennessee that is already utilizing some of the capabilities of TeamSense to connect, engage, and nurture employees so that when they do come online, they already have a relationship, they already understand the company, which is a really unique way. And thinking about that, that's a long, we'll say pull out, but given their area and where they're putting the factory, they know that they need to start that process early and build that trust. As we see with manufacturing growing, like the demand for workers is going to continue to be very, very high. And so companies will have to think uniquely on how do they attract them to their particular location. I think the next slide, we actually do a quick map of this, which I think will be fun to show. So it's like, hey, where is this construction taking place? Where are we seeing new manufacturing sites come online? And then compare that to where the labor market is already tight. So why don't we jump to that one?
Yeah, and before we jump to, let me just ask
Yeah.
you, I want to look at the color bars on here. So it's interesting, if I look at Texas, there's different types of manufacturing coming online versus New York is one green bar, just focused on heavy industry. Any insight into the mix or how to think about that? Or is it all the same as far as planning for labor and attracting and retaining talent?
I mean, of course, there's a difference in the type of talent that you need at each one of these individual sites. And so being thoughtful around, what universities are nearby, like what the specialty is, where the raw material supply chain is into those factories. And so there's definitely some nuances there. There's also local incentives, right? And so, New York has a big push for clean energy. And so it makes more sense financially for companies to locate there versus other states when they're kind of doing all of their puts and takes on where the new factories are going to be placed.
All right. Well, let's jump to the next slide. But everyone, keep in mind Texas, Arizona, Louisiana, Ohio, Idaho. Those are the top five in terms of construction. So let's look at this map. The one on the left is where the manufacturing jobs are. This is from the US Bureau of Labor Statistics. And you can see the dark green is higher concentrations of folks working in manufacturing recently. And the one on the right is where the labor market is tight. So the reason I asked you to keep in mind those 5 states is let's look at the difference where where the tightness is. So 3 out of the 5 top states for new construction and manufacturing are in states with tight or very tight labor markets. What does that mean?
Buckle up. Do you like my like little crayon drawing? I feel like I got
You
the
use a
purple
protractor
crayon.
on that? It's very
That's
small.
right. And so like those states, like if you are operating in those states, buckle up. Already kind of doubling down on where the labor market is tight, having a lot more capacity come online is just going to make that tighter. And so the folks in those locations really need to think about innovative ways to engage, retain. And if you're building those in those sites, like think about that one site I just mentioned that's 24 months out from starting production, and they're already trying to connect, engage, and be an employer brand of mind for these employees for when they do come online. And so need to be really, really inventive. Interesting there is Arizona. They're not a huge manufacturing hub. The labor market is not tight. Hopefully you don't need a lot of fresh water for whatever you're producing, given the state of Arizona and the droughts. But either way, seems like a great opportunity to place a factory there where you've got a little bit more labor and kind of pull that element off the table.
So that might be an advantage depending on the type of manufacturing that is being planned there. I
100%.
I see a hand raised. That's great. We're keeping it closed to questions right now just because we have so many attendees. But if you do have a question, put it in Q&A and we will get to it. Friendly reminder, we see questions coming in. They look really good, so keep them coming. Okay, so we've talked about planning. We've talked about the difference between where the jobs are and where they're going to need to have more jobs or more people to fill the new production coming up. When I said we're going to start with the long-term impact, let's just recap those pretty quickly. And we've talked a lot about manufacturing in the last 10 minutes, but not as much as logistics. So walk us through the kind of the high-level things that people who are running these new sites need to keep in mind.
Yeah, so kind of talk through the manufacturing. Let's go into logistics. Obviously there's going to be a lower demand for maritime shipping. We're seeing some conflict right now that's actually impacting maritime shipping, and so that might come as a relief for many of our supply chain colleagues out there trying to navigate. We'll say no pun intended, navigate those troubled waters. And so as we do nearshoring and start bringing things into Canada, into Mexico, into the US, obviously the port cities will see some relief. You can expect to see traffic increases accordingly at border crossings. And so, as we think about where there's already delays in some of the border crossings, we can expect those to increase as more and more goods are shared among kind of the continental US. Obviously, with that is a demand for warehouse space. Again, I talked about, at least when we're considering looking at new locations for our factories, we would constantly be overlaying the routes of intermodal transportation. Everybody does that. Everybody's there. That's why you have these kind of manufacturing hubs and logistics hubs around the country, is that everybody's looking at these kind of crossroads of intermodal transportation. It's already tight there. And so thinking about, what your long-term space plan is, whether or not your logistics company owns the warehouses or whether you're a 3PL that kind of operates within somebody else, expect those prices to go up as the demand for warehouse space in these critical locations is needed by everyone. And then lastly, and kind of uniquely to logistics, is that labor shortages will push automation and innovation, I believe. And so, manufacturing, when you think about the roles, the individual employees are like, might be production employees, but they're all trained on a specific tool to do a specific job at quality, at rate. In logistics, most of the workers are doing the same thing. There's a pick and pack. They're driving a fork truck, and we've seen, some of our customers have pulled back the curtains a little bit on their innovation. We've seen some really, really cool automation already happening, and I expect that as labor becomes tighter and tighter and tighter, that in order to kind of maintain efficiencies and maintain pricing, logistics companies will be forced to think through automation and innovation. Some of the cool things we've seen are like pick and pack virtual reality. So the person is at home with like a joystick and able to operate a machine in the warehouse in order to pick and pack. There's also kind of route automations that allows them to pick more efficiently. And so expect to see a ton of kind of automation and innovation in order to compete over time in logistics.
And I imagine as some of these production plants are built, the warehouse space needs to correspond to that as well. So probably folks looking at building out new storage and distribution hubs to meet the new demand that's being created by those manufacturing sites, right?
Yeah, and if they can't, then you're looking at just-in-time production and integrations and APIs to keep everybody on the same page, and like that just further tighten, we'll say knit between the manufacturer and the supply base. And so lots of kind of movement going on there, but all pretty exciting stuff to be in this area.
Well, let's shift to the near term. We saw some of those really steep curves, and so let's talk about what those steep curves in the 23, 24 timeframe mean. Let's just take a 12-month perspective, and we'll start with this finding from Deloitte. Manufacturing executives are thinking about this. They know that those steep curves mean that they need to move quickly, and what does that mean for how things are going to change in the near future year or two?
Yeah, I mean, kind of the theme is playing out from the long term and into the short term and even kind of echoed as I started off with my trip last week, is that at the top of everybody's mind is how do we actually retain the workers that we have? We've invested quite a bit into getting them up to speed, getting them trained, getting them cross-trained, having them produce at quality, at rate. Like the most costly thing that can happen is we actually lose those workers to somebody else. And so expect in 2024 to really continue to drive that focus in retention of workers, and lots of things kind of pointing in this direction that that's going to be true. But as we go into some of the other slides, there's some good news kind of on the horizon as well.
And we've talked about attracting talent. You're saying you need to be thinking about retaining talent, even that place that's using TeamSense 2 years in advance of running production lines. They need to be thinking about how to keep the talent, even while they're thinking about attracting it.
100%. I mean, you put a ton of investment into these folks. And so, it's really, really costly to lose folks. And I think, the summary is people have choices. I already mentioned that, there's manufacturing centers and logistics centers around the US are generally in similar locations because of access to intermodal transportation. And so if you think about it from the employee perspective, if they're not getting what they need, they literally can turn left into a different driveway versus turning right and change nothing about their life other than their employer. They're going to live in the same house. Their kids are going to go to the same school. They're going to shop at the same grocery store. They're going to have the same doctor. And they're literally just turning left versus right. And so companies need to be really cognizant on trying to understand their employees and then delivering against those retention goals. Now, this is really interesting for folks that have been in manufacturing. This is the average weekly hours production employees in manufacturing, seasonally adjusted. But what you can see there on the green bar is a 40-hour work week. I think it's well known, and in every single time, like we talk to customers, like running overtime is just part of the business. It makes sense if you have continued rise in demand and you've got a continued labor shortage, that in order to meet that demand, like you need to run overtime. What we're seeing here, though, is a decent drop if you look at kind of 2021 into 2023, about like kind of the demand of overtime on those workers, which we all know that over time that takes a toll. But I think we haven't seen since basically the recession in 2008 and then the bleep in COVID, manufacturing workers go below 40 hours. And so our prediction is that we kind of sit just above 40 hours. You will still have a little bit of overtime, but not nearly the amounts that we've seen in the past couple of years, which is, I think, great news for everybody that works in manufacturing.
So, because that overtime over time, it takes a toll on folks that are working long hours over and over again. That's starting to ease up a little bit.
We've got some qualitative evidence for sure of employees saying that, and then in a couple slides, we've got some quantitative evidence that we think backs that up a little bit.
And then this is the other side of that equation, job opening rates.
100%. So this graph is just showing job opening rates just for manufacturing, transportation, and warehousing utilities. You can see kind of the colors there. And that's falling to near pre-pandemic levels. So we're starting to level back out. What's really interesting is while the job openings kind of shot up in 2021, 2022, the total employment in manufacturing just like continues to remain flat. And so while there are still openings, the employment did not come in. It did not necessarily bring in new folks from other industries to join manufacturing. The levels just kind of remain flat. And so that tells me that, folks are kind of trading workers for the workers that are moving around. And that, leads to a little bit of, what's happening in education and trying to get more and more folks into skilled trades and into these type of jobs. But either way, kind of, again, the demand for labor remains really, really strong. And it seems like companies are starting to adjust to the new normal. Without new folks coming in, the job opening rates are falling, the overtime's falling, and they're just saying, hey, we need to get more efficient and more productive with the folks that we have.
We will get to questions in a second. I see some great questions coming in. Something else changing, job quitting rates are in decline.
Yes, this is it's pretty exciting. When we go and visit customers, they have told us lots of times, they're like, oh my gosh, like the number of quits that we have is insane. It's been the highest since, my 30 years in the industry. And what the data shows is like, that's not just a feeling, like that's legitimately happening. Like look at the chart on the right, where you see kind of jobs quit rate really skyrocketing post kind of pandemic 2020 and 2021, and then 2022 it finally starts to come down. There was a dramatic decrease, 15% from December 22 to November 23, and so we're finally reaching kind of those pre-pandemic levels, which is great news for everyone out there. We know that no call, no shows, and then just continuous no call, no shows is a bane of all of the production folks' existence. And so seeing that job quit rate come down is a huge relief for so many folks in the industry.
And we didn't put an overlay of this on declining rates of overtime, but it looks like it's happening simultaneously. So that would sort of make sense if folks are having to work overtime less, the odds of them quitting might also be decreasing. I'm just guessing looking at the timing of those curves, but there might be a relationship there.
For sure. Like all of this stuff is connected, absolutely, and impacts an individual worker, for sure.
And so absenteeism, another indication sometimes of whether people are planning on leaving or doing something else. These are up.
So
Absenteeism.
yeah, which is interesting, right? And so as we look at now the 2023 data on absenteeism from the Bureau of Labor Statistics, to make this apples to apples, is not yet out, and so you only see kind of 2022, and so some of those decreases that we've seen in overtime and some of those decreases that we've seen kind of in quit rate should impact absenteeism, and ideally we would see that come down. But if we look at kind of just the 2019 through 2022, what you guys were kind of feeling out there is true. Absenteeism was a problem and increased, 26% from 2019 to 2022. And that's really kind of, again, linking back this idea of we've got a fixed labor pool, we've got more demand. How do we meet that demand? Naturally, you're going to, ask those fixed labor pool to work more hours. You've got overtime, and that just kind of adds up, and people need a break. And so this kind of reliance on just adding more worker hours to produce to get to your output number, it could be taking a toll on employee well-being and morale.
So quitting's up, overtime is down, absenteeism is up, and of course, wages are an indicator of all those trends. Hourly wages up pretty consistently over the last couple of years.
It has been. This graph here is just showing kind of the impact of 2023. Now, 2023 was notable because there was a UAW strike. That strike took place like mid-September through mid-November. So you can see kind of the bar on the chart there. And then interestingly, right after is where we saw kind of a pretty big jump. Overall, wages rose 5.6% in 2023, and this was outpacing inflation, which would be kind of the normal bar at 3.4%. And so, causation, correlation, unknown, but the UAW strike and more importantly, the kind of the resultant publicity, like that was everywhere on every news channel, every day, and their kind of unique approach to how they were doing their collective bargaining agreement, drew a lot of news and attention, may have contributed to an increased wage. And so, again, you're kind of layering on, you've got, high absenteeism, higher wages. At the same time, you've got some overtime driving, to meet the new demand. And so it's a unique atmosphere kind of boiling up, which if we move to the next slide, we kind of sum it up a little bit here. So workers are working longer and are paid more, but are they producing more? And so what's really cool about this graph is it shows the hours worked kind of across the bottom. So as you get, 2% hours more worked, up to 4, up to 6% hours more worked. On the y-axis is the output. And that line you see there is what you would expect. So if I put in 2% more hours, I would expect to get 2% more output. Any bubble kind of below that line means that there's an inefficiency. As they're putting in more hours in, they're not getting the same one-to-one output back. And so what does that mean? I think one is, as you think about having to, do more with less, and get that output because you have a fixed labor pool, is that there's going to be a focus on how to be more productive. So being more productive is how do you get more units produced per unit of input? And so ideally you would want that graph to be on that vertical. There's a couple industries there that have hit it pretty well, but then most of them, as you see, are below into that red in that inefficiency space. And then you'd expect businesses to really focus on how to be more efficient. And so this is really the resources that we have, how well are those utilized, and are we doing that properly? And so you can expect to see both of those being a focus as we go into next year. And again, if you think about every time you're running that overtime, trying to hit those demand numbers, you're not getting that one-to-one input. And so obviously figuring out how do you reduce that is even more important than what you would think, even on the one-to-one input side of things.
And really quickly, before we go into Q&A, productivity and efficiency, what's the difference between those two things and how should leaders think about it?
Yeah, so if you want more productivity, it's how many units are produced per unit of input, right? And so if you've got like an input of time, I'm producing, 60 jobs per hour. Getting more productivity is how do I get that same line to produce 62 jobs per hour? Where efficiency is how well your resources are used. And so, are you using, less wire and individual raw materials in there? Are you using less labor hours? Is more efficiency on the unit itself versus how much you can produce in that same amount of time.
Thank you. Okay, I see some questions coming in. We'll get to those. Just to recap really quickly, short-term impacts on manufacturing and logistics, things that Sheila has shared. Job quitting is coming back to pre-pandemic levels. Sites are having to do more with less in terms of people. That's not going away because of the trends we've talked about. And productivity and efficiency will continue to be top of mind. So before we get into questions, just a quick plug for next Tuesday's webinar. We'd love for all of you and others to join us. We're talking with our customer at Yanfeng that is in the automotive space. That'll be a really great conversation between Rob Bolina, our head of sales, and Devin Freischeiser from Yanfeng. So sign up for that, and we'll see you at that. But let's get into questions. Reminder, you can send new questions into Q&A. I've gotten a couple already, so let me jump into that with you, Sheila. The first question was about advice for HR leaders. What advice do you have about navigating this environment with all the changes?
So, during the pandemic, HR leaders really earned kind of a seat at the table. And so now they're at the table, they're business partners with their GMs, their factory. And I think what they really need to do is start speaking the language of business, right? Like engagement and retention is something everybody says like, yes, we need. But how do you translate that into the language of business, which is dollars, which is translating that into like, hey, for every person we leave, that's going to cost, $11,000. Here's our turnover rate. Here's how engagement we expect to increase by X%, which then increases in dollars. The other thing is figuring out how things that HR impacts that productivity and that efficiency number. So if you think about, adding new tools, like what is that doing to productivity and what is that doing to efficiency? For example, with TeamSense, we do a lot of business cases with our customers in bringing, what the benefit of TeamSense is in reducing absenteeism, reducing no call, no shows into the business. And we're really looking at like, hey, if we can get more people here, there's going to be less overtime. Less overtime saves us this amount of dollars, and starting to bring that all the way through to dollars. And so my advice to HR professionals is to really start thinking about what KPI that the business already measures will be impacted on whatever initiative you want to go. And then beyond just that KPI, how do you then translate that to dollars and something tangible that the business understands so that they can compare, do we do this initiative versus do we buy, a new machine that makes the conveyor belt move faster? That's a really basic idea, but they get the sense of like, okay, you've got lots of different ways that you can impact productivity and efficiency. How do you make sure that your initiative is, one, the most useful case for those dollars, but two, is people understand what dollars impact you're going to make, and then track that and deliver that is of course the backside of that promise.
And here's a question about retention. We touched on it briefly. Retention continues to be a big focus for us. What advice do you have for HR leaders to improve employee retention?
We've seen a ton of really, really cool things that our customers have done that are frankly really inspiring. But I think if I kind of like summed it up into a bit of advice, it's, folks are sending out the annual engagement surveys, right? And so they send out the annual engagement surveys, the employees respond, they get some responses to that. Then what the folks will do is they'll go into a room and they'll plan out a series of activities that they want to purposely do that moves the needle on those engagement activities. But the thing is they never connect those activities back to like that bucket that they're trying to impact and then back and communicate that to employees. And so what they're hoping then is that, hey, by, doing X, Y, or Z, like Popcorn Friday, that the employees then remember like, oh yeah, they did Popcorn Friday. That meant that, we had the ability to network with our coworkers, which really meant to impact, that I know and trust the people that I work with. Like it's too many leaps for employees to make on the individual activity to how that impacts the engagement survey. And so some of the best companies are, constantly kind of communicating like, hey, you asked for a way to better network with your coworkers. We issued, a program on Popcorn Friday and every Friday, and just kind of keep hammering that over and over and over again. And if you think about it kind of like a marketing message, so like, what is your overarching marketing theme? What are you going after? Don't try to boil the ocean, but be really purposeful and then connect all of your activities back to that overarching theme so that employees, when they come to the end, they remember what you did. And more importantly, they link those actions to what the engagement survey had. And then you actually get to build a little bit of that trust with the employee on like, hey, you took my feedback, you actioned it, and then we saw the results. And so that would be the best advice that I have for, engagement retention is really think about what you're doing with purpose and link that back to the specific metrics that you're trying to move the needle on.
That's great. And the next question that came in is about really looking upstream with education. The question is, do you see the education sector responding to teach or train more young people for careers in manufacturing?
I think this is still mixed. Everybody knows that it's a problem. I think, we're starting to see a little bit with the cost of a 4-year degree continuing to rise and definitely outpacing inflation, and more folks, kind of opting out of saying, hey, I don't want to get into a really long-term debt situation. And then at the same time, the rise of kind of manufacturing and the roles there and the number of jobs and the fact that you can go there and it's not just a job, it's a career. It's starting to be really, really attractive. I don't think we've yet kind of can declare victory on that. That motion is just starting. And I think it takes years before we start to see kind of some of those generational norms that have been pounded into people's heads start to change and say, hey, you know what? There is a better option, or there is alternative options. You don't just have this one path. But there's more of a cultural shift that's required before we'll see meaningful results in the manufacturing industry.
All right, one last question, Sheila, and I'll put this information up while we ask and answer this one. I've saved the easiest one for last. How will the 2024 election impact these trends?
Yeah, that is a pretty easy one. We talked about the bipartisan support. Obviously we've got a lot of government incentives, a lot of movement, and kind of a light bulb moment of holy smokes, manufacturing is really, really important to us from a national security standpoint, from a job standpoint. I think 12.6% of the current economy is associated with manufacturing already, a current GDP. And so just really kind of bolstering that. And I don't see that going away with both parties. We've seen it already happen between the Trump era initiatives, and then kind of followed on and almost doubled down by the Biden era. And so no changes there, which I think is great news for us and everyone on the line.
All right. Well, thank you, Sheila. This has been a really interesting conversation, and thanks for the folks that sent in questions. Next Tuesday, we will be talking about a customer who's used TeamSense and the results they've gotten, and all the creative ways that they've used TeamSense to influence some of the trends we've talked about today: retaining employees, engaging employees, et cetera. So we hope you can join us next Tuesday. Sheila, thank you so much for taking time this morning, and really appreciate it.
Yeah, it's my pleasure. Thanks for having me.
Thanks, everybody. That ends this webinar. Have a great day.